Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we are diving into a topic that every investor and trader eventually learns the importance of, sometimes the hard way. That topic is defensive investing, and specifically how to protect your capital when markets become uncertain, volatile, or unpredictable. Now, when people first enter the world of trading and investing, the conversation usually revolves around growth. We hear about finding the next big stock, catching major trends, or building wealth quickly through smart trades. And while growth absolutely matters, there's another side of the equation that's just as important, if not more important over the long term. That is capital preservation. In today's episode, we are going to explore what a defensive investing strategy actually means, why protecting your capital is essential for long-term success, and the practical methods investors use to build portfolios that can withstand market turbulence. Let's start with the basics. A defensive investing strategy is an investment approach designed to minimize losses during market downturns while still allowing investors to generate steady, long-term returns. In other words, defensive investing is not about avoiding markets. It's about managing risk intelligently. Rather than concentrating capital in highly volatile assets or speculative growth stocks, defensive investors focus on assets that tend to remain relatively stable during periods of economic stress. Typically, defensive investments share several characteristics. They tend to have lower volatility. They often generate consistent earnings. Many provide reliable dividend payments. They usually belong to companies with strong financial fundamentals and healthy balance sheets. And importantly, they often produce goods or services that remain in demand regardless of economic conditions. Think about industries that people depend on every single day: food, electricity, healthcare, household essentials. These are areas where demand rarely disappears, even during recessions. Companies operating in these sectors often provide the foundation for what investors call defensive portfolios, and they play a critical role in a long-term defensive investing strategy. Now, before we dive deeper into the mechanics of defensive investing, it's important to understand why protecting capital is so critical in the first place. Many investors underestimate how damaging large losses can be. Let me walk you through a simple example. If your investment portfolio loses 20%, you don't just need a 20% gain to recover. You actually need about 25%. If your portfolio falls 40%, you now need a 67% gain to get back to where you started. And if you lose 50%, you need a 100% gain just to break even. That's the math of drawdowns. Large losses create a recovery problem that can take years to overcome. This is one of the key reasons experienced investors often focus on risk management first. By limiting downside risk, you make it easier for your portfolio to grow steadily over time. A well-constructed defensive investing strategy for protecting capital helps investors reduce the likelihood of those severe drawdowns while still remaining invested in the market. And that last point is important. Defensive investors don't panic and exit markets completely when volatility appears. Instead, they structure their portfolios in a way that cushions the impact of downturns. Now let's talk about the core principles that make defensive investing effective. The first principle is diversification. Diversification is one of the most powerful tools investors have for managing risk. Instead of concentrating all of your capital in one asset or one sector, diversification spreads investments across multiple asset classes. A diversified defensive portfolio may include dividend-paying stocks, government bonds, corporate bonds, real estate investment trusts, commodities like gold, and even cash reserves. The reason diversification works is because different asset classes respond differently to economic conditions. For example, when stock markets decline during recessions, investors often shift capital into safer assets such as government bonds or precious metals. By holding multiple asset classes, you reduce the overall volatility of your portfolio. This approach forms the foundation of a defensive investing strategy for volatile markets. The second principle involves investing in what are known as defensive sectors. Certain industries tend to remain stable regardless of economic conditions. Three of the most commonly referenced defensive sectors include consumer staples, healthcare, and utilities. Consumer staples companies produce everyday necessities like food products, cleaning supplies, and personal care items. These products are essential, so demand remains steady even during economic slowdowns. Healthcare is another classic defensive sector. People continue to require medical treatments, pharmaceuticals, and healthcare services regardless of the broader economy. Utilities, which include electricity, water, and natural gas providers, also generate stable revenue because these services are fundamental to modern life. Because demand in these sectors tends to remain consistent, they often perform relatively well during market downturns. Including these industries within a defensive investing strategy for volatile markets can significantly improve portfolio stability. The third major principle of defensive investing is dividend income. Dividend-paying stocks form a cornerstone of many defensive portfolios. Companies that consistently pay dividends are often mature businesses with predictable cash flows and disciplined management teams. Dividend income provides investors with several advantages. First, it generates regular cash flow. Second, it reduces reliance on capital gains alone. Third, dividends can be reinvested, allowing investors to benefit from long-term compounding. And fourth, dividend-paying companies often experience lower volatility compared to highly speculative growth stocks. Over long investment horizons, reinvested dividends can contribute significantly to overall portfolio performance. Investors who follow defensive dividend investing strategies often look for companies with long histories of consistent or growing dividend payments. These companies are sometimes referred to as dividend aristocrats or dividend kings because they have demonstrated the ability to increase dividends year after year. The fourth pillar of defensive investing involves bonds and fixed income securities. Bonds serve an important stabilizing role in many portfolios. Unlike stocks, bonds provide predictable interest payments and return of principal at maturity. Common examples include government bonds, high-quality corporate bonds, and Treasury inflation-protected securities. During periods of stock market volatility, investors frequently move capital into bonds because they are perceived as safer assets. This movement can help offset losses in equities. Including bonds within a balanced defensive investing strategy helps reduce overall portfolio volatility while generating consistent income. The fifth component of defensive investing is something many investors overlook, and that's cash. Cash might not produce high returns, but it plays a very important role in portfolio defense. Holding cash provides liquidity and flexibility. When markets decline sharply, investors with available cash have the opportunity to purchase high-quality assets at discounted prices. Cash also reduces portfolio volatility and can provide psychological comfort during turbulent market periods. For many investors, maintaining a cash allocation of roughly 5 to 10% can serve as a practical component of a defensive investment strategy. Now let's talk about how defensive investing applies during periods of economic uncertainty. Financial markets can become volatile for many different reasons. Rising interest rates, inflation spikes, geopolitical tensions, global financial crises, or economic recessions can all create instability. When these conditions arise, markets often experience sudden price swings and heightened uncertainty. A defensive investing strategy during economic uncertainty focuses on minimizing potential damage while still positioning investors for future recovery. In practical terms, investors may increase exposure to defensive sectors, reduce holdings in speculative assets, increase bond allocations, strengthen dividend income streams, and maintain higher cash reserves. The objective is not to perfectly predict market movements. Instead, defensive investors aim to build portfolios that remain resilient across different economic environments. Now, in today's digital world, technology also plays an increasingly important role in how investors manage risk. Modern trading platforms offer powerful tools that allow investors to analyze markets more effectively. Features such as real-time data feeds, portfolio analytics, technical indicators, and automated alerts make it easier to track market conditions and adjust investment strategies when necessary. If you're looking for a world-class, cutting-edge, and user-friendly trading platform, you can explore the tools available at crystalballmarkets.com/platform. The platform is designed to help traders and investors monitor financial markets, analyze opportunities, manage risk, and execute trades efficiently. Having access to the right tools can make a significant difference when implementing a defensive investing strategy. Another important element of defensive investing is education. Understanding macroeconomics, market cycles, and investor psychology can dramatically improve your ability to navigate market volatility. One of the best ways to stay informed is by regularly listening to discussions and analysis from experienced market participants. If you're looking for beginner-friendly insights into trading, investing, macroeconomics, and financial markets, you can check out the podcast series available at iss.com/podcast/crystalballmarkets. These discussions break down complex financial concepts into practical insights that investors can apply in real time. Education builds confidence, and confident investors tend to make more disciplined decisions during periods of uncertainty. Finally, it's important to remember that defensive investing does not mean abandoning growth opportunities entirely. The most effective portfolios often combine both defensive assets and growth investments. For example, a balanced portfolio might allocate 50 to 60% toward defensive or dividend-paying stocks, 20 to 30% toward bonds or other fixed income assets, 10 to 20% toward growth sectors, and a small portion toward cash or alternative investments. This kind of diversified structure allows investors to benefit from market expansion while maintaining protection during downturns. Younger investors with long time horizons may choose slightly higher exposure to growth assets, while investors approaching retirement often prefer a more defensive allocation. The key is aligning your portfolio with your financial goals and risk tolerance. So to wrap things up, market volatility is unavoidable. Economic cycles, interest rate changes, and global events will always influence financial markets. But investors who focus only on aggressive growth strategies often expose themselves to large losses during downturns. A well-designed defensive investing strategy helps protect capital, reduce portfolio volatility, and maintain steady progress toward long-term financial goals. By focusing on diversification, defensive sectors, dividend income, bonds, and strategic cash reserves, investors can build portfolios that remain resilient through different market conditions. Successful investing isn't about avoiding every downturn. It's about building a strategy strong enough to endure them. And over the long run, investors who protect their capital during difficult periods often place themselves in the best position to benefit when markets recover. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.